and economic stories, business stories, uh, what the heck is going on with crypto, what the heck is going on with the meme stock short squeeze, why workers aren't going back to work, and some ways small businesses can hack it in this cold, cruel world. Let's get started. From CNBC, Bitcoin surged as much as 18% after a wild day that saw the cryptocurrency briefly drop below $30,000. And if you're a Bitcoin hodler, this is just another Wednesday. Bitcoin sank below the $33,000 threshold Tuesday, at one point briefly erasing all of its 2021 gains. On Wednesday, the world's biggest cryptocurrency climbed more than 18% to trade back above $34,000. Bitcoin had a solid start to the year, but has been on a roller coaster ride more recently amid a slew of negative news. Bitcoin continued to rebound from its lows for the year on Wednesday. The cryptocurrency sank below the key 30K threshold Tuesday, at one point briefly erasing all its 2021 gains. It later recovered to turn positive for the day. It was like just a V-shaped bounce. On Wednesday, Bitcoin surged 18%, climbing back above the 34,000 mark in early morning trading, according to Coinmetrics data. It last changed hands at 33,641.27 cents, up 3% on the day. Small rivals also surged, with Ether rising 6% and XRP up 9% at a price of 64 cents. The reason for the moves higher wasn't clear, but cryptocurrencies are known for their volatility. Yeah, no freaking kidding. Bitcoin had a solid start to the year, rallying to an all-time high of almost $65,000 ahead of the crypto exchange Coinbase's blockbuster debut, and as institutional investors appear to be warming to it. But the world's biggest digital coin has been on a roller coaster ride since, almost halving in value amid a slew of negative news. In China, authorities have been clamping down on Bitcoin mining, the power-intensive process for validating transactions and generating new Bitcoins. Over the weekend, Beijing's crackdown on crypto mining extended to the hydropower-rich Sichuan province. Then, the People's Bank of China on Monday said it had urged financial institutions, including Alipay and major banks, not to provide services related to cryptocurrency activities. So, blame it all on China. They're cracking down on mining and their banks from using it. So everyone in China is getting out of it. Investors have also become more concerned about Bitcoin's environmental impacts after Tesla CEO Elon Musk decided to stop accepting Bitcoin as a method of payment for his company's vehicles. At the time, Musk said he was worried about Bitcoin's huge energy consumption and the rapidly increasing use of fossil fuels in mining the digital asset. However, he later said Tesla would accept Bitcoin when at least half of Bitcoin mining is confirmed to be powered by clean energy. And we'll get to that in the next article. Critics of the cryptocurrency have long been wary of its impact on the environment. That could threaten the adoption of Bitcoin by institutional investors, which are under growing pressure to invest in cleaner, more ethical assets. And we've gone over this. Compared to, like, say, mining physical gold or running all the transaction networks of traditional banks or wire services, Bitcoin's energy consumption is negligible. Meanwhile, there have also been concerns about Tether, a so-called stablecoin whose price is meant to be pegged to the US dollar. Tether is now the world's third largest digital currency, with a market value of more than $60 billion. But some investors are worried Tether's issuer doesn't have enough dollar reserve to justify its peg to the greenback. Last month, the company behind Tether broke down the reserves for its stablecoin, revealing that 76% was backed by cash and cash equivalents, but just under 4% of that was actual cash, while about 65% was commercial paper, a form of short-term debt. It comes after the New York Attorney General's office reached a settlement with Tether and Bitfinex, an affiliated digital currency exchange. Tether and Bitfinex are actually owned by the same company. The state's top law enforcement official had accused the firms of moving hundreds of millions of dollars to cover up a loss of $850 million in commingled client and corporate funds. So, Tether and Bitfinex agreed to pay $18.5 million in the settlement and were barred from operating in New York State. However, the companies didn't admit any wrongdoing. So, Tether's going to be a problem because we just don't. If you follow a few other crypto YouTubers, they've like I believe CoffeeZilla had a really good video on them. Tether's run by a bunch of really shady characters, and we really can't trust whether it's backed by anything solid, anything real. Bitcoin, it's meant to be secure, based on cryptography coding and the distributed blockchain and the public ledger. Everything is like transparent, and everything is supposed to be run automatically. It's not run by any like individual organization or person. So that's what gives Bitcoin its value. It's the security of the blockchain. Tether and some other, and I would also say XRP. They're run by centrally controlled companies. So take that one. Consider that. Next article, also by CNBC. China is kicking out more than half of the world's Bitcoin miners, and a whole lot of them could be headed to Texas. This is very good news. In May, Beijing called for a severe crackdown on Bitcoin mining and trading, sending off what's being dubbed in crypto circles as the Great Mining Migration. Texas is an ideal destination for miners, thanks to its abundance of solar and wind power, its unregulated market, and its crypto-friendly political stance. China has long been home to more than half the world's Bitcoin miners, but now Beijing wants them out ASAP. In May, the government called for a severe crackdown on Bitcoin mining and trading, setting off what's being dubbed in crypto circles as the Great Mining Migration. This diaspora is underway now, and it could be a game changer for Texas. Mining is the energy-intensive process which creates new coins and maintains a log of all transactions of existing digital tokens. Despite a lack of reserves that caused the days-long blackouts last winter, Texas often has some of the world's lowest energy prices, and its share of renewables is growing over time, with 20% of its power coming from wind as of 2019. It has a deregulated power grid that lets customers choose between power providers, and crucially, its political leaders are very pro-crypto. Dream conditions for a miner looking to find a welcome and cheap energy sources. You're going to see a dramatic shift over the next few months, said Brandon Arvanaghi, previously a security engineer at crypto exchange Gemini. We have governors like Greg Abbott in Texas who are promoting mining. It is going to become a real industry in the United States, which is going to be incredible. China's mining dominance. 2021 data for the global distribution of mining power is not yet available, but past estimates have shown that 65 to 75% of the world's mining happened in China, mostly in 4 Chinese provinces: Xinjiang, Inner Mongolia, Sichuan, and Yunnan. Sichuan and Yunnan's hydropower make them renewable energy meccas, while Xinjiang and Inner Mongolia are home to many of China's coal plants. The drawdown in miners has already begun in Inner Mongolia. After failing to meet Beijing's climate targets, province leaders decided to give Bitcoin miners 2 months to clear out, explicitly blaming its energy misses on crypto mines. So, and the story goes on, because miners at scale compete in a low margin industry where their only variable cost is typically energy, they're incentivized to migrate to the world's cheapest sources of power. Every Western mining host I know has had their phones ringing off the hook, says Carter. Chinese miners or miners that were domiciled in China are looking to Central Asia, Eastern Europe, the US, and Northern Europe. One likely destination is China's next-door neighbor, Kazakhstan. The country's coal mines provide cheap and abundant energy supply. It also helps that Kazakhstan has a more relaxed attitude about building, which bodes well for miners who need to construct physical installations in a short period of time. Texas not only has the cheapest electricity in the United States, but some of the cheapest in the globe, says Arvanagi, Dieter Arvanagi. So, answering the Musk critique. Tesla CEO Elon Musk has bashed Bitcoin mining, claiming that it's bad for the environment, and it's not a new criticism. For years, skeptics have maligned the world's most popular digital token for polluting the planet, while supporters have extolled the virtues of Bitcoin and its role in accelerating the rise of renewable energy. It's unclear whether the China mining exodus will make or break the case for Bitcoin enthusiasts, as the debate around the token's carbon footprint. The dominant narrative to date has been that much of the world's Bitcoin is mined with Chinese coal. From a narrative perspective, it's definitely an improvement, said Carter. But China also has the most abundant stranded hydro resources in the world. The country offers significant energy vectors from wind, solar, and especially hydropower in the south. Xinjiang's grid, for example, is 35% powered by wind and solar energy outputs. If all the miners do end up leaving China, it will mean less fossil fuel powered mining, but it will also mean that the network's share of renewable energy powered mining will drop. This is why the question of where these migrant miners end up could prove critical to Bitcoin's future. It's the biggest story of the year for Bitcoin, said Carter. Mining is price sensitive, so as to seek out the lowest cost power, and the lowest cost power tends to be renewable, because if you're burning fossil fuels, it has extraction, refinement, and transport costs, explained Blockstream CEO Adam Back. So, a lot of the cryptocurrency mavens I listen to are actually very happy about China kicking everyone out, because it's like you get conflicting information about China's own environmental regulations, because it's such a tightly controlled authoritarian regime. So we do want crypto mining to happen in more free and open countries. I know that the mayor of Miami, Florida, wants to do more crypto mining in his locality, and he also wants part of the city treasury to be stored in Bitcoin. So a lot more governments, either national governments or city or local or state governments or provincial governments, they're warming up to cryptocurrency. And we've seen El Salvador wanting to use it as legal tender. I've heard that several, I believe the Republican National Committee or the Congressional Committee, they're accepting donations in cryptocurrency. So it's mainstream. It's just I believe most of the price action, the price drop recently in Bitcoin is due to a lot of manipulators in the media and the big whales that they call so-called, they have the big accounts. They try to whip up excitement about it, and then they short it. It's called the Wyckoff distribution, and I mentioned and I discussed it in my blog about a month ago. More Bitcoin news. BIS says Bitcoin has few redeeming attributes. So who is BIS? It's the Bank for International Settlements. The organization there represents most of the world's central banks. They panned Bitcoin, and its annual economic report said the cryptocurrency has few redeeming qualities. The bank offered a stiff criticism of Bitcoin and cryptocurrencies in general in a chapter from the report published Wednesday ahead of its full release on June 29th. Cryptocurrencies are speculative assets rather than money, and they are used in many cases to facilitate financial crime such as money laundering and ransomware attacks. Bitcoin in particular has few redeeming public interest attributes when also considering its wasteful energy footprint. The report arrived less than 2 weeks after the BIS's Basel Committee indicated the risk level it assigns to crypto assets by proposing that banks with exposure to them should set aside capital to cover any losses. Stablecoins, which are designed to be less volatile than other crypto assets by being backed by fiat currencies, also came under scrutiny. The report called them an attempt to import credibility and said they are only as good as the governance behind the promise of backing, and that they threaten to fragment the liquidity of the monetary system. CBDCs are moving from concept to design. Cryptocurrencies and stablecoins are highlighted as part of a triple-pronged threat to mainstream financial services, alongside disruption by big tech. The BIS set these threats against the backdrop of growing interest in central bank digital currencies, CBDCs for short, which have drawn the interest of most central banks around the world. CBDCs are growing from concept to design, the report said, and could reshape the institution of money. The bank said digital cash should be designed with the public interest in mind, ensuring an open payment platform beneath the shadow of a competitive level playing field. It noted that the benefits of the CBDC depend on the competitive structure of the underlying payment system and data governance arrangements. According to the BIS, CBDCs would function optimally if they were based on a two-tier system where the majority of customer-facing activity is taken on by commercial banks and other payment providers. 3 months ago, the bank released a detailed research note outlining the importance of countries collaborating to eliminate traditional banking frictions for CBDCs. The bank also noted the most promising design for everyday use of CBDCs is if they were built atop an identity scheme whereby data privacy would be safeguarded while staving off illicit activity. While not entirely new concepts, the discussion shows that CBDCs, in the eyes of the bank for central banks, are on their radar. So, this is so predictable. Central banks, they run by basically printing money and then loaning it to governments, which loan them out, or they also loan them out to banks, commercial banks, and they pretty much get everyone in the world on the hook to debt. Whether it's governments, it's your politicians, it's your judges, it's your corporations. They're pretty much on the central bank's leash, and that's why it doesn't matter who you vote for. They're going to be like, whether it's whatever party you're in, they're going to toe the line to the central banks. So, and that's why cryptocurrency is such a huge threat to them. Cryptocurrency, Bitcoin is digital gold. It's there will never be any more than 21 million Bitcoin, and it's not controlled by a single organization. So, ponder that. Moving on. This is from LotusEaters.com. London-based hedge fund shuts down after suffering heavy losses in the GameStop stock price squeeze. Oh my gosh, that's so hard to say. So, the first casualty in the whole saga has taken place. So, a London-based hedge fund, which at its peak managed $440 million in assets, has closed down following a review of its business model. White Square Capital, along with several other hedge funds, had employed the tactic of short selling against GameStop and suffered double-digit % losses after the stock price rocketed. In January, the Reddit board Wall Street Bets was a springboard for an extensive exploitation of the short-selling hedge funds and traders, when members of the group rallied to inflate the price of GameStop's share price. Oh my God, this is such a tongue twister. Short selling is a method of trading where traders bet the stock price will go either up or down over time, selling stocks borrowed from a lender while the stock is at a high price, and then selling the stock again to return the lender when the stock is cheaper, or vice versa, with the short seller keeping the difference. Wall Street Bets, led by the Reddit user DFV, exploited the short sellers by artificially inflating GameStop's share price through mass media coordinated buying, attempting to trigger a short squeeze where short sellers begin closing their positions at higher and higher prices in order to return them to the initial lender. GameStop's share price was able to reach $347 on the 27th of January and $265 on the 12th of March, allowing early buyers of the stock, which rose from its price of $17 in the beginning of January, to make unprecedented gains. The so-called meme stock has steadily risen in its value over recent months, with the company raising $1.1 billion in cash after it sold 5 million of its common shares on Tuesday. At the time of writing, GameStop stock price was $213. So, what the whole saga has revealed is regular retail investors who are just regular folks like you and me, they coordinated to raise the price of whatever stock they wanted, and it pretty much revealed that these big name hedge funds and Wall Street, institutions, they did the same thing. However, the institutions are protected by the government, and the retail investors, they don't have that. That's one thing. What we're going to look at the next little page here is that if regular people go after the hedge funds, then it's going to strike a blow at the entire economic system, which will go straight up to the central banks. So, what does it usually mean when governments bail out hedge funds? This is on Quora, the question and answer website, and we've got a few people in the know telling us about when hedge funds are bailed out. Governments don't bail out hedge funds directly. This person, who's a CTO at a funding platform, he says it usually means you're reading into either a parody website or a fake news website. The only news stories I've seen about the American government bailing out hedge funds affected by the GameStop crisis have been parody sites. The actual class of bailout is when the government announces its financial report to all businesses, and then some expose claims to reveal that this includes hedge funds, but the journalist writing the story tries to have a headline that concentrates on the hedge funds rather than 99% of other businesses. So, for example, the UK government's COVID furlough support scheme was available to financial sector companies. It seems likely that at least one hedge fund applied for at least one employee to be furloughed. But generally, governments are willing to bail out banks only when those banks are so interconnected that the entire system is at risk, and failure of the bank in question would lead to hundreds of other non-banking businesses also failing. Even in those cases, the owners of the banks and the bank shareholders aren't typically protected, and the taxpayer becomes the new owner of the bank. This person says it means they rob you either through taxation or printing up money, which devalues your paycheck, and give that money to some rich fat cat who lost their money in a bad gamble on Wall Street. So, this person says governments don't bail out hedge funds. I don't know of any hedge funds that have been bailed out by the government. They let long-term capital fail in the 90s and Lehman Brothers and the 2008 financial crisis. If a hedge fund is bailed out, it's usually from other hedge funds or banks. That's the answer here. The government does bail out big banks, however. So we saw the what was that, Melvin Capital, they were bailed out by other hedge funds. And then those hedge funds were supported by commercial banks, like, the major corporate bank chains that you probably have business with. So to bail banks out, the government gives the banks a huge loan to cover its losses. The banks have to pay this loan back over a series of years. The government doesn't give them free money, so to speak. It's more like an interest-free loan from the American people. These loans are usually in the form of buying partial ownership of the bank or buying securities from the bank. It appears that the government made a $110 billion profit from the loans of its 2008 and 2008 to this date. Too bad they didn't disperse this to the people as our profit. That being said, bailouts absolutely help the hedge funds. This is because the bailouts to the banks definitely trickle down invisibly to the hedge funds. So I guess the answer is the government doesn't do it directly or intentionally. They just don't regulate where the bailout money is spent well enough. So That's probably the best, answer I've seen to the question. So it's basically a ladder, or just one step up, up, up until you you basically shut down the hedge funds. Then if you squeeze them hard enough, it'll shut down the other hedge fund, the bigger hedge funds that bail them out. If you shut down those hedge funds, they'll have to be bailed out by the banks. And if you shut those banks down, they'll have to be shut down. They'll have to be bailed out by the Federal Reserve, and the Federal Reserve being the final boss. So, do we want this to happen? Well, do we like being on the hook do we like being in debt to the Federal Reserve? That's the question. I just downloaded Ron Paul's and the Fed book, and I'm gonna look at that more closely. Now, switching gears entirely from Deadline, Peter Bart. As America reopens, workers quitting in droves amid tension, stress, and burnout. This is from last week, June 17th. This was supposed to be that upbeat, long-anticipated week when masks came off and people reconnected with their social lives, maybe even considered a return to the office, or at least a trip to the movies. Instead, a more complicated scenario seems to be unfolding. Bars and restaurants are busier, but a sullen undertone persists. New surveys show that a substantial percentage of the workforce has decided to quit their jobs rather than return to work, rather than return to the office. They are willing to work remotely. That's true in Hollywood's executive suite as well. There are pervasive symptoms of burnout, reports Christina Maslach of the Center for Healthy Workplaces at UC Berkeley. It's like a light bulb is burned out, but not the whole fire. According to the Wall Street Journal, where pre-pandemic workers craved job security, the present wave of resignations is the highest since 2000. The upshot is a major disruption in the ways companies must do business. The author decided to do his own small survey this week by talking to several entertainment executives who, contrary to the trend, had returned to work. I asked them to list some of the changes that they would like to see in their workplace, promising confidentiality. A sampling of responses: there's too much tension at work, personal and political. One said, I don't like an HR presence in every meeting. People are afraid to chat honestly with one another, especially about diversity. The subtext: tensions pervasive in society about race and sex are impacting the office. There's an overlap between burnout and stress, says Inger Burnett-Ziegler, a clinical psychologist at Northwestern. The stay-at-home syndrome has fueled political explanations. The rejection of big city life, a fear of crime as well as COVID, the passage of government-aided subsidies. The contrary point of view, however, traces burnout to tensions related to compensation. It's all about gaps, explains one senior executive. Even if you're moderately successful, you inevitably measure yourself against the new billionaire class. There's also the fact that so much money has been printed over the past year and a half that wages and salaries don't mean as much anymore. A study commissioned by the New York Times found that the gap between CEOs and everyone else has widened during the pandemic. The report concluded that even in a gilded age of executive pay, 2020 was a blowout year. Obscure CEOs like Alexander Karp of Palantir, a data mining company, earned $1.1 billion in pay last year. Meanwhile, only 13 female CEOs made the top 200 list in terms of compensation. Obsession about the billionaire class was heightened by last week's report from ProPublica, revealing that billionaire investors pay no federal income taxes in recent years. Jeff Bezos, the world's richest man, did not pay a penny in federal taxes, the report found. The reaction from the press was predictable. Given that this country has been through COVID, and given how hard it is to earn a buck, this new glimpse into inequity is generally disgusting, Maureen Dowd wrote in the Times. Summoning up Dickens, she added, paging Madame Defarge, where did you get your knitting needles? A new report on banking also underscored the question of excess. According to The Economist, banks essentially are flooded with money. billions of dollars of cash in which they aren't sure what to do with. That's what, because the Fed printed so much, they banks are just overloaded. And I discussed this in another blog article on my website. I reported on a video by Crypto Casey. There's just too much cash right now, and banks are like super eager to lend it out so they can just get rid of it. A company like Verizon holds $10.2 billion in cash, up 45% from a year ago, while corporate bank deposits overall have surged to $17 trillion, according to the Federal Reserve. It's reassuring to have money in the bank, to be sure, but the financial arena has become a giant shark tank, one media executive commented. Everyone lines up, begging for money from the sharks, who demand an even bigger, ever bigger piece of the pie. No wonder the show leads Friday night in ratings. Inevitably, tensions over compensation spill over into the arena of diversity. Are women gaining ground as much as men? Blacks and Latinos may be making gains in job opportunity, but has their compensation followed suit? Says one media CEO, the pressure from the diversity chorus is fierce. I'm looking for input on talent, and instead, I'm yelled at about quotas. The upshot: more people of all strata seem to be taking the easy path by opting out of the marketplace. This week was supposed to deliver freedoms, but it's turning out to be a daunting display of burnout. So, in the comments section, the office is now obsolete, and anyone who can work from home should work from home. So many people who've gotten used to working at home, they would rather quit their jobs than go back to the office. They would rather find another work from home job, or they'd rather start their own business from home. That's what I'm doing with this channel. And a little bit later, I'm going to talk about the need for having a website for your business, whether it's like retail or restaurants or what have you. Moving on, this is from the Epoch Times. More than an exodus. Dropping birth rate threatens California's future. This is going to be this article is pretty good because it touches on a lot of diverse topics. As California's population declines due to mass exodus of residents escaping high taxes, exorbitant housing costs, and increasing homelessness, another factor has been quietly contributing to the downturn: the declining birth rate. While the Golden State's population continues to grow older, young adults are having fewer children, data show. The state's natural population growth, the difference between births and deaths, has been slowing since the 1990s, according to the Public Policy Institute. From 1991 to 2010, the natural growth hovered above 280,000. But since 2015, it has declined from 247,000 to 181,000. In 2019, the state had 11.3 births for every 1,000 residents, the state's lowest rate in over a century. The long-term effect of the state's dropping birth rate is hard to predict, because the current administration's border policy has made immigration numbers unclear, says John Morlack, a former state senator and Orange County supervisor. But if immigration is minimized and there's zero growth, Morlack said, the old rule in businesses should apply. If you're not growing, you're dying. And while some researchers assumed there would be another baby boom during the pandemic, the stay-at-home orders apparently have had the opposite effect, resulting in historic lows for births across the country. There was the pandemic itself, but then there was also, of course, the economic situation. People are losing their jobs. Dr. Brady Hamilton, statistician and demographer for at the Centers for Disease Control and Prevention's National Center for Health Statistics, told the Epoch Times. All that speaks to uncertainty, and certainly a factor that people would consider in terms of having a child in their economic situation. Hamilton and other researchers at the CDC released preliminary data for birth rates in the United States in 2020, based on nearly all the birth records received and processed by the NCHS last year. For women aged 20 to 24, the provisional birth rate last year was 62.8 births per 1,000 women, down 6% from 2019. The birth rates were lower in all major age and racial groups. Hamilton said that while the data gives some insight to the situation, further investigation is needed to get a clear picture. That has to wait for the surveys to sort of tease that out, Hamilton said. But we can do quite a lot for our own part, looking at the impact that this downturn has had across the country by various groups to get a better sense of how it affected the births. In California, the country's most populous state, the birth rate dropped by more than 10% in December 2020, roughly 9 months after the start of the pandemic, compared to the same month a year earlier. The state logged just short of 33,000 births for the month, more than 3,700 fewer than a year earlier. According to Hamilton's research, the total fertility rate among women nationally also dropped in 2020, down 4% from 2019. Although birth rates vary among married and unmarried couples, marriage licenses are also at record lows, according to the California Department of Finance. Based on data, as reported by select California counties, there has been an overall decrease in marriage licenses issued compared to previous years, beginning in March 2020. The CDF told the Epoch Times in an email statement. When it comes to babies born in and outside of marriages, the CDC will look deeper into that in its next countrywide report, expected to be released this month. We don't typically have it in the provisional report, Hamilton said. Our report does have births to married and unmarried mothers. We have that, but it's not typically the provisional report. But that's another dimension that we'll look at. They don't have records of household income, he said, but they do have a proxy for socioeconomic status, which is education. They plan to look at that with the final data for 2020 as well. Affordability. This is big. Frank Bean, a professor of sociology and the director for the Center for Research on Immigration, Population, and Public Policy at the University of California, Irvine, has some ideas on California's falling birth rate. One thing I think is important is that 90% of the population in the United States is not making any more money than they did 20 years ago or 30 years ago, Bean told the Epoch Times. Parents are making less once you adjust for inflation. In other words, incomes have been stagnant or declining, especially for people at the bottom. In today's modern economy, people have children when they can afford them, he said. During the pandemic, when child care services weren't readily available, that also figured into couples' decisions. According to a 2021 study, Californians need an individual average annual income of $111,533, with no additional debt to afford to make payments on a medium value house in San Jose, Los Angeles, or San Diego. They need an individual income of 6 figures in California, basically to just live. That's unsustainable. No wonder people live in California. In 2018, the California Budget and Policy Center reported that at least a third of state residents spent more than 30% of their incomes on housing, and as many as 20% spent more than half of their income on housing costs. Almost all the circumstances operate against having the kind of flexibility, resources, and long-term goals that childbearing entails, Bean said. Places like Orange County, where wages are higher and more women are in the workforce, provide better environments for childbearing, he said. Statewide, women aged 20 to 40 make up 47% of the workforce, according to the CDF. Immigration and education. Immigration and the rate of movement into California also will skew the data, people familiar with the situation say. Bean, who has studied migration from Latin American countries, said he found that women who are foreign-born tend to have more children than U.S.-born women. But recently, the rate of second- and third-generation Latino women having children is also declining. The second-generation Latino women and the third-generation Latino women have fewer children than foreign-born Latino women, and the bulk of the Latino population is Mexican-American, but their fertility has been going down too, he said. Bean said the children and grandchildren of immigrants aren't much different from the general population. As more embedded and active they are able to become in the American economy and American society, the more their childbearing patterns look just like the rest of the population. People are also waiting longer to have children because it's not as easy as it was 30 years ago to raise kids, he said. There's lots more labor-saving devices and technological changes and so on, But in terms of how much money people make and how much they have to pay for housing, it's much more difficult, he said. The rise of women in the workforce is also adding to the falling rates. There are a lot more demanding professional jobs available to women than there were 3 decades ago, Bean said, such as medical or law work. The people who stay in college longer to earn advanced degrees tend to slow down childbearing. But the one group that's having larger families, quite a bit larger, are rich people. They are more likely to have 3 or more children, said Bean. And that's not very many people, but it's kind of notable. And it proves the point that you really do have to have all the resources to take care of all these things she needs, like childcare. He said some people have enough money, they can earn a law degree, work a professional job, have lots of kids, and still enjoy family life. The number of people migrating to other states has increased during the last 5 years because of housing and childcare costs, he said. How much money people make has become amplified and magnified so that even people equipped to do whole professional jobs are leaving. Long-term impact. The dropping birth rate might take 20 or 30 years before it has a noticeable impact, according to Morlock, who said there may be benefits as well as disadvantages. We still have other issues where a declining population might be a good thing, he said, citing concerns about the water supply, housing shortages, and overcrowded freeways. So it gets really interesting. But the biggest concern is going to be whether or not the one percenters leave. Population gets older, which means you have to have more people servicing those individuals. And so it gets to be a real interesting problem, he said. Morlock said he likes to look for corollaries when analyzing situations, in this case, by studying states that are also not growing, and how that has affected them the 10 to 20-year period. So, obviously I've been to Michigan, and I drove through Detroit. That's awful. You know, when you see empty houses and boarded up factories, that's not pretty, he said, mentioning Illinois, New Jersey, and New York as other states that have seen significant exoduses. Morlock drew a correlation between rising taxes on the wealthy and dwindling state populations by looking at Connecticut, which he called a suburb of New York. We saw that when they raised the tax on the wealthy reduced their taxable income by 50%, he said. The wealthy know how to buy taxes in bonds or set up charitable trusts or whatever to reduce their taxable income. But then the legislature had to respond by raising taxes on the middle class. Obviously, if we have an infrastructure that isn't growing, it's going to be somebody who winds up paying more. He said, you squeeze that balloon, and maybe it could just be the middle class that'll have to start putting in a larger share of the tax revenues to support an infrastructure that is currently growing too fast, thanks to all the money that's showing up. He said that Governor Gavin Newsom isn't thinking recession yet, but when it comes, it's going to be really awful. It's going to be worse than what former Governor Arnold Schwarzenegger faced when he showed up in it during the liquidity crisis, he said. So, one thing that's just like eating up these blue states is housing costs. So, I mean, you need to have a 6-figure income to afford to live in California. That's so unsustainable. So, yes, please come to Iowa, come to Arizona, come to Idaho. Just don't vote for the same politicians, and at least spread out the housing developments. One reason housing is so expensive in some of these areas is because there's not enough development. There's just not enough housing to go around, so supply and demand kicks in. Now's a good time to talk about ways to support my channel. I've got a list of affiliate links in the description. If you're watching on Facebook or on YouTube, I've collected a bunch of resources that'll help you start a business, get funding for a business, invest in cryptocurrency and physical gold for your retirement. I've listed my preferred web hosting company and my preferred WordPress theme, which will let you design a website through a point-and-click interface. And if you need to hire a freelancer to help you make that website, click on the link to Fiverr. All these links are affiliate links, and I'll get like a commission if you go through them. So that'll help support my channel. Moving on. Local retailers fight to compete with online marketplaces. This is from smallbiztrends.com from last week. So, small businesses have really, got hurt bad by the lockdowns. And so many state and local governments have shut down small businesses while letting big box stores like Target or Walmart or Amazon run just fine. So, what can be done? A new Shopify merchant consumer research reveals local retailers are fighting more than ever to compete with online marketplaces. This, as the economy starts opening after what seems like an never-ending pandemic. Competing with online marketplaces. According to Shopify research, and Shopify is a very popular online e-commerce platform that you can build your own online store with. According to Shopify research, 2 in 5 local retailers are struggling to compete, and 59% say they may need to close their doors in the next 2 years. However, almost 2/3 of small business owners are implementing different tactics to compete with major online marketplaces. Local retailers are improving store atmosphere by 50%, offering more product variety, and providing better customer service, increasing store hours, and much more. Local brick-and-mortar retailers are also selling online to compete, but the report says they are underestimating things that stop consumers from buying. According to Shopify, they can solve this problem with omni-channel selling and technology. Shopify says local retailers need to view offline retail as one sales channel and not the entirety of their business. And by highlighting different differentiators, they can start driving customers through their front door as well as an online presence. This includes customer service, convenience, and price. Shopify solutions. Along with the report, Shopify is making a new capability in its app. This new feature enables local retail discovery. This means customers can discover retail merchants nearby based on proximity, sort by local delivery and pickup, see trending shops close by, and more. So, local filters. Users can locate merchants that are nearby so they can support local businesses. The app identifies businesses that are offering shipping and pickup while highlighting return policies. Seamless payment and checkout. Using ShopPay, customers can access fast and easy checkout across all brands on the app. Transparent tracking and customized recommendations. The future of retail is flexible. Flexibility is essential for local small retailers to stay alive. As the Shopify report wisely points out, the idea of selling in only one way is outdated. This, the company says, is because commerce is changing too fast to sell only one way. And this also includes physical retail space. The key is technology because it allows small businesses to stay nimble. With the right solutions, they can optimize their entire operations. From staff to space to sales channels, retailers need to use the available technology and get comfortable with it to stay nimble. So, Shopify solutions. I'm going to look at this in another video because one big problem local businesses have is visibility. If you know where Target is in your city's main drag, or if you know where the chain restaurant is on your city's main drag, you may not know what local restaurants are in your area or local shops. So advertising is expensive. So you need to get on Google My Business and you need to have another marketplace like DoorDash. And we're going to be talking about DoorDash in a little bit. Let's move on to ways to fund your business. And this might also be a good investment opportunity for some of you. Top 7 equity crowdfunding platforms for businesses and entrepreneurs. This is from Merchant Maverick. This is a website that's dedicated to helping businesses sell online. It takes money to make money. It doesn't matter if you're in the beginning stages of launching your business or if you've been in the game a while. Capital is necessary to ensure the success of your business. Of course, there are loans, lines of credit, and other traditional types of funding available at your bank or through an online lender. But there's another option that should be on your radar: crowdfunding. If you're only loosely familiar with the concept, you might think of GoFundMe's brand of medical and charitable crowdfunding. You may also think of rewards-based crowdfunding platforms like Kickstarter and Patreon, in which entrepreneurs and artists solicit funds from backers in exchange for a physical product or exclusive creative content. What if we told you there existed an entirely different form of crowdfunding, one in which entrepreneurs and startups receive funding from backers in exchange not for gifts or products, but for an equity stake in the company? A crowdfunding campaign in which the backers are investors. That's what we're here to talk about. In this article, we're going to look at equity crowdfunding, what it is, who could benefit from this type of funding. We'll also offer our top recommendations for equity crowdfunding platforms. What is an equity crowdfunding platform? Equity crowdfunding is a way to raise capital to start or grow your business. Investors invest money in a business in exchange for equity, typically in the form of shares in the company. So, an investor receives ownership in the company, and in return, the company receives the capital it needs to launch or expand. This varies dramatically from rewards crowdfunding, which offers investors some sort of reward, like a discounted or free product, in exchange for the investment. So a lot of crowdfunding is basically pre-orders for your product or your book or your project. Aside from what the investor receives in exchange for their money, another primary difference between equity crowdfunding and rewards crowdfunding is how much money can be raised. Typically, equity-based crowdfunding is best for entrepreneurs and companies who need large amounts of capital to start or grow their businesses. An equity crowdfunding platform is an online platform that allows you to pitch your business to potential investors. These platforms typically require a fee for the service, but in exchange will allow you to post information about your business so you can connect with investors to meet your financial goals. Equity-based crowdfunding got its start later than rewards crowdfunding, because crowdfunding involving investments was, until relatively recently, illegal in the United States. Enter the Jumpstart Our Business Startups Act, better known as the Jobs Act, passed by Congress and signed into law by President Obama in 2012. The Jobs Act amended federal securities regulations to legalize equity crowdfunding. The reasoning was that allowing startups to publicly solicit investment via crowdfunding would help spur the economy in general and startup formation in particular. In the business world, equity crowdfunding is new. In fact, the reality of equity crowdfunding hasn't yet lived up to the loftier predictions of those who pushed its creation. Nonetheless, the fact remains that billions of dollars have been raised by startups and companies via equity crowdfunding. For the right kind of businesses, equity crowdfunding represents a prime opportunity. A warning about equity crowdfunding platforms. Let's pump the brakes for a moment and go over the disclaimer that some of the Merchant Mavericks equity crowdfunding reviews. Bear in mind that equity crowdfunding is a still evolving field, with the full impact of the Jobs Act still being assessed. Equity crowdfunding is a more complex proposition than, say, rewards-based crowdfunding, as investing is much more substantially regulated. Consult an attorney if you have any legal questions regarding the process, SEC regulations, etc. In short, equity crowdfunding is legally complex. Be careful and don't get into trouble. So I'm just going to list off the best crowdfunding sites here. I'm not going to read the whole paragraphs, but there's WeFunder, best for regulation crowdfunding. EquityNet, best for entrepreneurs and small private businesses. There is Crowdfunder, which is best for tech and finance companies. Fundable, best for flexible crowdfunding options. So, AngelList, best for crowdfunding with no monthly fees. So, it's possible they just maybe skim a little bit off everyone's investment. Seedinvest, best for startups with high growth potential. Microventures, best for businesses with a unique idea. So, in your spare time, search Merchant Maverick equity crowdfunding. So, now I promised you a discussion about DoorDash. This is from supplychaindrive.com. Albertsons strikes deal with DoorDash as it pares down delivery fleet. Albertsons is a chain of grocery stores, I think. Albertsons announced Monday that it will offer delivery from nearly 2,000 stores in as little as an hour through DoorDash's marketplace app. DoorDash will offer delivery of more than 40,000 products from Albertsons, with no minimum order size required. Albertsons will use DoorDash Drive, the delivery firm's white label e-commerce platform, to power online shopping in select markets. The tie-up continues Albertsons' push into third-party marketplaces as it pulls back on operating its own delivery fleets in certain areas. So, now I've done DoorDash a little off and on quite a bit last year, and I didn't just deliver restaurant food. I deliver a lot of groceries. Here in Iowa, the dominant grocery store chain is Hy-Vee. About half of my deliveries were just going up to Hy-Vee's, Aisles Online department, pulling up to their delivery area and letting the workers, load up my car, and I would deliver groceries to a customer. So people would actually shop for groceries through DoorDash. And one of the benefits of these delivery apps is marketing for your store or your restaurant. You can basically, put your products up on DoorDash or Grubhub or Postmates, and you have like an online local marketplace ready-made. So, moving on. Albertsons' delivery alliance with DoorDash is part of the grocer's ongoing journey to strike a profitable balance between third-party apps and its own delivery assets. Earlier this year, news emerged that Albertsons would discontinue using its own delivery fleets in markets like Southern California and Texas, and instead rely on popular companies like DoorDash and Instacart for its last-mile fulfillment. Albertsons was already among major chains to build out its own delivery fleet at banners like Safeway, seemingly offering an advantage to the grocer as online orders swelled during the pandemic. Kroger, its close national competitor, launched its own delivery fleet this year, which is now making deliveries in Florida and Ohio. But operating refrigerated trucks and staffing its own drivers is also very expensive, and Albertsons has decided that these select areas to bet on outsourcing and the prospect of enticing the millions of customers currently using third-party apps. Albertsons is now DoorDash's largest grocery partner. The firm, which launched grocery delivery last year, delivers from groceries like Hy-Vee, Mayer, and Farmstead. It also operates its own online convenience chain, DashMart, which operates in 18 cities. After a fiscal year in which it recorded a 258% increase in digital sales, Albertsons is positioning itself for sustained long-term growth as rivals like Amazon, Walmart, and Kroger also expand. The grocer offers pickup service for more than 1,400 locations and plans to integrate more automated micro-fulfillment centers to process online orders in population-dense markets. So there. It was either last year or a couple years ago, I heard that Postmates was teaming up with Square, the online payment system that's very popular among small businesses. So if your business runs Square as your point of sale system, local customers can shop your products through the Postmates app. So that's another possibility. One more article, and I'm out of here. The rise of peer-to-peer logistics. This is from airfreight-logistics.com, and this is from, I believe, a couple years ago. Yeah, this is from November of 2019. I thought I'd talk about this because logistics and supply chains are a big deal right now. The pandemic shut a lot of it down, and this morning I saw a video by Crystal Cigar, two pundits who used to be with The Hill, but now they've gone independent. They talk about how in America we've gotten more and more dependent on manufacturing and shipping from China, which is unacceptable given their activities with the Wuhan lab and our activities in Hong Kong. Now is the time to, revamp our shipping network and revamp our supply chains. Thanks to the increasing ease of which users are accustomed to adopting newer technologies, creative delivery services are being developed that give all parties greater flexibility and options. A popular delivery trend that has been gaining traction over recent years is that of peer-to-peer deliveries. It has become known as the Uber of the logistics industry for its similarity to the popular self-service taxi application. Just like Uber transformed the taxi market, some are maybe concerned whether peer-to-peer will dramatically disrupt traditional logistics and transportation businesses. While we're still in the beginning stages of this emerging segment of logistics, peer-to-peer is certainly an innovative way to deliver goods, and it fills a niche that has been previously underdeveloped. Digital platforms are breathing life to peer-to-peer services with the development of the platforms that enable the connection of the senders, bringers, and receivers. AFL, that's the company that runs this website, they recently had a great opportunity to explore this area further by speaking with two peer-to-peer service providers, Ms. Daria Rebanuk, CEO and co-founder of Grabber, Mr. Ari Keston, CEO at Nimber, and logistics solution expert Mr. Edward Hapala, managing director at DSV Solutions, about how peer-to-peer services work, security management, as well as their views on the future of peer-to-peer shipping. And I won't read the whole article, but we'll see how peer-to-peer works. As seen by the two service providers we talked to, peer-to-peer shipping has different approaches and ways people can get involved. Both services have a similar shared feature where travelers that have extra space in their luggage can post their travel plans and offer others the ability to transport goods they need removed or brought to them. The difference between the services is that while Nimber is focused on the customer sending a product they already own to another location, Grabber offers users the ability to select items they would like brought to them. Both companies fill a niche in offering similar but distinct different advantages with their services. Nimber's focus is on the community for those who want to send something to another city via a traveler who's going in that location, and they have enough empty space in their car or suitcase to bring goods along. Senders can either go to the website or download their app, register, and indicate what and where they want to send. While the bringers can get paid for their empty space during the trips, the senders also get an amazing value proposition, great experience, and cheaper delivery costs. On the other hand, Grabber has a focus on the shopper, where they can create an order by describing the items or simply pasting a direct URL to the product. Grabber will then match the request with travelers heading to the shopper's city. These travelers will bid to deliver the products. The shopper chooses the offer that works best for their schedule and budget. After being matched, the shopper and traveler arrange delivery via in-app messenger and submit secure payment. Travelers hand deliver items to shoppers, signed, sealed, and delivered. Most importantly, travelers get paid only after the shoppers receive their orders. So that is another type of gig economy app. So you can deliver products while you're traveling. So isn't that amazing? So if you have an idea for, if you're in the logistics business or the supply chain business, and you have an idea on how to improve the process through technology, and you want to use it on blockchain, I have another affiliate link. It's to Ivan on Tech's Academy. Ivan on Tech has a great YouTube channel where he talks about cryptocurrency and also decentralized apps based on the blockchain. So click on that link, and that'll help support the channel as well. And with that, I'm going to let you go. I hope you found this, information valuable. If you did, give it a thumbs up, click the subscribe or follow button, and share it. I hope you